Welcome, everyone. This is Kyle Cain and Peter Culver from Freedom Family Office, and we're here with another edition of Rich Beyond Money, your guide to personal and financial freedom. Today, we're going to talk about cash, how to think about it and what to do with it. So in the world we work in, people often have cash for a variety of reasons. They might have inherited some funds. They might have sold a business. Sometimes cash feels good, a little money under the mattress, so to speak. But there are definitely some thoughts around why cash is actually not a good investment to hold. And the major point there is inflation. So if we think of what's going on today, if you have your money in a bank, maybe you're earning 1%, maybe you're earning a little bit more, but inflation is somewhere between 4 and 7% right now, depending upon how you look at inflation. So there are opportunities to earn more return beyond keeping your money in cash. So part of what we're going to talk about is if you accept that view that cash isn't optimal, what do I put my money in and when do I put it to work? So Kyle, let's talk about the when. And I guess there would be two different scenarios that an investor might face in terms of putting money to work. The first one would be the market's really high. Is that a bad time to put money to work? How should an investor think about putting cash to work when the market is high?
Yeah, that's a great point. And we get that a lot when, you come into cash, you might have missed out on some of the market run and, the stock market's sitting at all-time highs, and definitely understandably people are concerned about, did I wait too long? Did I miss the boat? And, what we would say is statistically, that's actually completely untrue. Investing at all-time high is actually one of the best times historically. The stats show something like if you just invested on any random day in the stock market over the past 20 years, you would have earned a return somewhere around 11 to 12%. If you actually invested on a day when the stock market reached an all-time high, you would think that's a bad time to invest. And actually that number goes up to your next year return is usually around 14 to 15%. The reason is that there's usually momentum and no one knows when the bull market is going to end. And usually all-time highs create more all-time highs. If you start to even look at that data, people say, all right, well, that's a 1 year, anomaly. If you start looking at average 3 and 5 year returns, the numbers are even greater. That if you had actually invested, rather than just on a random day, invested at an all-time high, your average return over the next 3 or 5 years is significantly better than any other time. So we would say that, yes, obviously getting it on a great, sell-off, if anyone could ever be that lucky, great, but no one can time the market. So we would definitely suggest that now or any time is the best time to start getting your money to work.
So that's interesting. In one sense, I think the average investor would think that's counterintuitive, right? That the worst time to invest would be when the market's really high. Now, there could be other times, and we may be living through one of them right now, when the market's low on a relative basis. So just from a timing standpoint, maybe talk for a minute about, okay, I've decided to move forward, whether the market's high or whether the market's low. What's my timing in deploying the money? All at once a month? What would your advice be in that situation?
Again, it goes back to that no one has an exact crystal ball. There's lots of factors that internally, as an economist and investment manager, I'm looking at as far as how expensive the market is and how long has the bull market been going on and where interest rates are, et cetera. But we would definitely say, hey, if you're lucky enough to get a pullback, at a good time when you just all of a sudden have this cash, well, then we would say, go ahead and put more money into the market than you normally would. If it's at an all-time high, though, going back to my previous point, there's never a wrong time. Now is probably the best time to go ahead and put majority of the money to work. So to kind of sum it up, we would say that, it's definitely you want to get majority of your money to work as soon as possible because 3 out of 4 days, the stock market goes up. However, we would still believe that some portion of it, you can use some sort of strategic approach to it, a little bit more depending on your cash flow needs and your specific situation, but where we can, potentially dollar cost average in some of those assets over, let's say, some sort of time frame, 3 to 6 months. And then you just look at, if the markets get a pullback, you escalate that and put more in sooner. if the markets, do as they normally do. You just continue, stay disciplined, keep buying, more and more to the market.
That's our kind of timing discussion. That's the when to invest. I think we want to talk a little bit about the what to buy. And I think maybe there are two broad principles we want to talk about there. One is just the basic idea of diversification. So we've all heard it. Don't put all your eggs in one basket. You want to have a broadly diversified portfolio. And Kyle, maybe it'd be helpful just to talk a little bit about the portfolios, we build here at Freedom, how they're constructed, what the areas of focus are. How do we find that broad diversification that we think investors should be looking for?
Perfect. Yeah. I mean, that's oftentimes when people are looking at the markets and whether, we're at a high or at a low, they're looking at the S&P 500. However, there's a lot more going on behind the scenes as investable places. There's obviously international. There's certain sectors of the market that will potentially be at all-time highs where others are at all-time lows or at their 52-week low. So, we believe in having a diversified approach, to put all your eggs in one basket approach to investing. We're going to take into consideration, again, the valuations of different asset classes and overweight or underweight based on, the current market environment and what's most attractive. But like we said before, it's having get money active and into the markets, spread out the risk a little bit on where you're investing in the public market is going to, do well sooner rather than later. Another area that often individuals don't think about is we don't just focus on public markets. We're going to look at other areas that also, again, may have nothing to do with the stock market, so to speak. Private areas. We look at private equities and private real estate, for instance, can be in a environment where the interest rates rise or the stock market is tanking, I guess is a good way to look at it. There still could be great value in real estate where more and more individuals, inflation is pushing up prices and we can take advantage of. There are other areas are private debt or cryptocurrencies or things that we can look at beyond the typical markets and valuations. That not only helps with the risk and return in a portfolio, but also helps with that timing question is where, you never know exactly, when the top's going to be, but when you diversify, you reduce that risk significantly.
So maybe what we could do is take some of those general principles that we've been talking about and just as one example, apply them to some aspects of the current situation. So one thing that's going on now in the market is inflation is increasing, has increased. It had been on a 30-year decline. It's definitely making a pivot. So in an environment where inflation is going up, what in your view are the areas of opportunity in the market? Where would there be areas that you might emphasize more than if inflation was low?
Certainly. And, it is a tricky situation on which one is leading, right? Is it inflation or is it interest rates? And certainly we're in an environment where inflation is leading and the Fed is trying to play catch up as far as raising interest rates. So, oftentimes there's certain asset classes that perform better when inflation, and those same ones that perform better inflation, things like real estate, industrials, materials, commodities. These are all things that just, get pricing pressures pushing them up and can do well. When the Fed starts to raise rates, though, historically, rising interest rates may not be as good for some of those asset classes. So it's you have to keep a very close watch on how you invest in those markets. We would say the Fed is going to make moves with rising interest rates, but we're at such historically accommodative levels that they're well below the inflation rate. So, where we would say playing that inflation play is better for now and worry about the rising interest rate play a little bit further down the road.
Terrific. So I think another aspect of what's going on, at least right now, is all-time market highs in a variety of areas, more or less toward the end of the year. We've seen, give or take what area you're in, a 5 to 10% pullback. Time to put some money to work? Question mark. Wait a little bit longer. Back to our original topic. If a client had cash right now, how would you deal with the current market given the dynamics right now?
So definitely. I mean, in all of 2021, we only saw 5% pullback in the markets. And we have just now here in the beginning of 2022 seen a pretty significant where the markets are off 10%, and that's just looking at the S&P 500. If you look underneath the curtain a little bit more, the average stock inside of the S&P 500 is down well over 20%. So we would say that right now is, if there has been a time that you've been waiting, sitting on the sidelines, now is the time to act. Could it go down a little bit further? Certainly. But, when we start to pull back layers of what's happening in the economy, what's causing this, sell-off, a lot of it, again, it's just the fact that we've had a good market. People are starting to take some of their gains, off the table because they're concerned with inflation and the rising interest rates. But neither of those things, if you look historically, have caused the stock market to drop. The market actually does very well throughout a cycle of the Fed raising interest rates. The ultimate driver of the economy in the market is going to be the US consumer. And so right now, our main driver on what we think is going to happen is that the US consumer still has trillions of dollars in cash sitting on their balance sheets. Their debt, level ratios are, at all-time lows. They're eager and willing to spend. Obviously, the coronavirus out there has caused some, as a wave we've just seen, the most recent wave is causing a little bit of delay in some of that spending. So it's just that much more pent-up demand that we should see, released here throughout 2022. And some of those inflation risks, the supply chain issues will, although not be solved, they should start to come down. So we think it's a pretty attractive market environment currently to be investing, with those main pillars of the U.S. consumer, corporate balance sheets, inventories that they need to, fill back up, hopefully receding, inflation later this year. That, all signs point to now being a great time to get some of that cash to work.
So again, if we go back to the kind of where we launched off, I think it's an interesting conclusion. If one had a lot of cash and one was sitting in the middle of an environment where the market just went down, depending upon whether it's the whole market 10% or some specific stock 20%, someone might say, yeah, you'd be crazy to put your money in the market. But I think what you're saying is it's actually an ideal time really for two reasons. One is it's lower now than it was before. So everything else being equal, probably a more opportune time to invest. But there's actually lots of opportunity out there because at least we feel the fundamentals that are likely to drive the market in the future higher again, those haven't changed. The market's really coping with the virus. That's probably a transitory situation. The market, the Fed are trying to figure out what to do about interest rates, but those underlying drivers are still in place, correct?
Certainly. It's, if you would have came into 2022, and we were to have a consensus on what we think would happen, earnings are still projected to be pretty good. And no economist or analyst has differed from that point of view yet, that earnings still look to be pretty good for 2022. There obviously could be some version of valuation compression. So point being is, maybe we had an estimate of a 10% return in the markets in 2022. Well, now with the sell-off, guess what? Now, if you invested today, you're looking probably closer to a 20%, return again for 2022. And you compare that to losing 6-7% in cash, it's a pretty big difference there. And we would definitely say, it makes a lot more sense to, get invested.
Cash is not something to be fearful for right now. So we thank you for joining us, Kyle Cain, Peter Culver from Freedom Family Office. If you found this program interesting, you'd like to see how this might apply to your own situation, please reach out to us. We'd love to speak about your own situation in more detail. Thank you very much.